What's going on, everybody, and welcome back to the second episode of the Next Big Thing HQ Investor Series. We are extremely excited to welcome on Jessica Millstone. She is the co-founder and managing director of Copper Wire Ventures. Copper Wire is dedicated to helping women entrepreneurs with patient, strategic capital for their technology-driven companies, products, and services. They primarily invest in the future of learning and work, but consider investments in crossover tech-enabled sectors as well. Jessica wanted to make sure that we mentioned she's not making any new investments right now for anybody that might be listening. We had a really interesting conversation before we started recording the episode about how she is an advocate for not only female entrepreneurs, but female investors alike. So I'm looking forward to getting to know Jessica's frameworks and her experience as a venture capitalist. So with that being said, welcome on the podcast, Jessica.
Thank you. I want to say that what you just mentioned about how I support both entrepreneurs and investors is part of the reason why we're not making new investments right now, is that we are really focusing on that second part of trying to get more women investors into the ecosystem. So I do a lot more kind of advocacy work around that, events, support system, building support systems for that, as well as designing Fund 2, which will be making new investments, hopefully 2024.
Fantastic. I'll hand it over to Connor and let him ask you the first question.
Well, Jessica, once again, thank you for coming on. We appreciate you taking the time out of your day to come on. And I really wanted to just jump into it and talk about Copperwire Ventures' mission. And the mission is to help fund female entrepreneurs and help fund their startups. And you had a very interesting statistic that said 2.7% of all venture funding going to women founders in 2019. That's 2.7% out of 100. So there's a huge disparity between the amount of funding that goes to males versus females. So can you talk about that issue and how Copperwire Ventures is trying to solve that issue?
Well, that's really the reason why we started the fund. So the fund began very organically out of a family office that was mission driven to help women entrepreneurs, and looking around and seeing how best to do that, to support that system, and really just saw this was a statistic that had been floated out in 2019 that, less than 3% of all the people looking for venture capital who get venture capital are women. So we wanted to build the fund to address that problem. And also we built it as a proof of concept fund to kind of think about how to learn about venture and get better at it and improve the system overall. And actually we launched right before COVID, and over the period of COVID, over the last 3.5 years or so, we've actually seen that statistic go down. So actually fewer women than in 2019 are being funded through venture capital, a critical problem to solve. And we're still working on that. Part of this year, 2023, has been to look both back at the investments that we've made through Copperwire Fund 1 and Design Fund 2, and think about how could we better serve exactly that population that's actually getting less and less capital along the way. So one of the tactics has been, as I said before, was to get more women investors into the system. So we're working on that as well as making new investments into startups.
Well, and I think the first step is always bringing awareness to the issue, which hopefully this podcast is going to do that. And with Copperwire Ventures, it's continuing to really shine light on this issue. Can you talk specifically, though, about the challenges female founders face? We had Brooke from Bench K12 on, and she mentioned a lot of the challenge, but is it more of even just getting the money, or does part of the problem stem from even before that, where it's just getting your foot into the door to have a meeting? So can you talk about the challenges these female founders face?
Certainly. I think that a big part of the problem is just imagining yourself as the type of investable startup that then can raise venture capital. So I think that women have still have a long leap to go to get themselves into the mindset of recognizing how valuable the startup is that they're starting, the products, the services, the business model that they might be creating. I think there's still a long way in valuing that, both from the venture capital side, but also just within themselves as entrepreneurs. I'll also say that I think that women not to overgeneralize too much about every woman, actually I try to never do. I think that women do actually start very problem solving, highly profitable, sustainable companies. And those companies are not always rewarded by venture capital. Like VC financing actually really privileges companies that are incredibly high growth and high exit, fast exit. And truthfully, like that's not always the kind of company that a woman wants to start. So I think it's coming at this from a lot of different angles and sort of recognizing like what, how VC can improve itself, maybe to morph more into the kind of financing that would reward those kinds of highly profitable, high revenue driven companies that are around for a long time, as opposed to the like fly high and flame out version. I also think that, women, as we go out to seek venture capital, and, I'm kind of in that boat too. I'm raising a fund too. So I'm like also out fundraising from LPs, very similar to what other women go through. We have to be better storytellers about what is the problem that we're solving and how we're actually going to be utilizing this money in the best possible way.
So, understanding what you just said about how traditionally venture capitalists look for high growth, fast growing startups that are, going to exit really quickly, right? And then taking your thesis and the way you look at startups, what are you looking for in founders when you make an investment?
That's such a great question because it really has evolved over my time of doing venture investing. I really consider this to be like one of those professions that's all about experiential learning. Like really, like you have to do it to learn how to do it, to get better at it, to do it again. And that's been my experience. And I think that that's truly how great, I think VC multi-fund firms sort of become the leaders that they are in that space. So one thing that I have looked for, what I started looking for and what I look for now is very different. When I am making a straight up VC investment, that I'm looking for the highest possible return and not thinking about it more as a strategic investment where I personally have a lot of expertise in the space and I'm offering not just capital, but probably some kind of level of support, operational support or coaching support in some way. If I'm looking at it from a straight VC perspective, I'm really looking at the founder and trying to evaluate whether that founder is a good fundraiser. I think what I've seen in my own portfolio and what I see sort of generally across the space is that you really, the way that a VC-backed company gets formed is that it's raising all the time. It's really figuring out how to balance its runway with the projections that they have about how their product is going to be out into the marketplace. And it's true for VCs as well. Like our metrics are that our portfolios get marked up when our companies raise again at a higher valuation each time. So it's really, again, like sort of preferencing companies that are raising all the time. So you have to look at founders who are not only just raising all the time, but really good at raising all the time. And that's not necessarily true for a business that I might do what I would consider more of an angel investment, where I am a strategic partner from the very beginning. These are companies primarily in the educational technology space where I spent 25 plus years of my career, both on the instructional side and on the product development side of that. I think that those kinds of companies, I'm really looking for a problem that you're solving, how much traction you might have, like really a slow organic growth that's going to be sustainable over the long haul.
That's super insightful because I never thought about it through that lens. That you need somebody when you're a venture capitalist and you're investing in somebody, you need them to be able to fundraise because your investment is only going to take off. Not necessarily about if they have a good product or if they can't raise any more money, you're not going to make out very well. I've never heard that said, and I think that's an incredibly insightful way to look at it.
It's really divided the kinds of investments that I make in my own mind, where there are some where it's really a VC investment and it's all about sort of like fostering that very high growth and fast exit strategy. And then there are some that I'm looking way more carefully at the P&L, at their projections, things that are very hard to gauge, I think, at the early stage. But like those are the things that are going to keep that company going over the long haul. So there's like short-term investments and long-term investments. There's ways in which I provide just capital and ways that I provide my expertise and my help. Like those are sort of the ways that I've started to divide out like what it is that I'm looking for from my end and how I evaluate the viability of that investment.
The importance of looking at it on a company by company basis. What you can offer a company as a venture capitalist or an angel is very different,
Exactly.
depending on what they do, what their product is. It makes a lot of sense. So the last venture capitalist we had on invested mostly in the pre-seed. That was kind of his sweet spot. He had a thesis based on why he liked to invest in the pre-seed. Is there a certain round that you like to invest in? I know you talked about doing angel investments and venture capital. What's your sweet spot?
I'm also a pre-seed investor. So, fund one, we started with a $2.5 million fund. So we're writing very small checks, 25 to 100K. We fully deployed that fund by the end of 2022 after making 30 investments across 25 different companies and then 5 funds. Went in as the LP in 5 different funds. So, that was very pre-seed. Those are like the earliest stage kinds of checks to write. As we design fund 2, I would like to stay at the pre-seed level because that's really the most exciting part for me is working with entrepreneurs. So, sourcing them, coaching them, like keeping in touch. I have a very accessible mentality to being a VC. I try to do a lot of work around demystifying the process for entrepreneurs, especially women entrepreneurs, making it a little bit less of a black box. So I would like to stay at the pre-seed level, and that will mean writing, hopefully slightly larger size checks, but still staying in that very early stage.
So I have 2 questions that I want to ask. First, for female founders, they're pre-seed. So with being pre-seed, smaller startup, how do you find them and how do they find you? What's that process like?
That's a great question. Also, like I said, I try to be accessible. Like I feel like that's part of our brand at Copperwire Ventures is we have a form on our website. Like anybody can fill out the form and get a reply from me via email. I attend a ton of events. I'm always being a mentor or participating as a shark in a Shark Tank or, working with different accelerators and event programmers to get the word out about me, but also like to be helpful, like to people who are just looking for information in the space. And so I think because of that, my deal flow is like a fire hose. Like I've never had any trouble, sourcing deals. That's for sure. I feel like also if there's like a woman in the ed tech space who's raising capital, like they find me pretty quickly because I have a very small niche around that. So it's pretty easy to like, the Venn diagram layover is tight. So, and, again, like we're not out for volume. Like that's not the strategy of our fund. We're really looking to do as many of the strategic style investments as possible rather than just the sheer financial outcome ones.
So strategic style investments, are you looking specifically at the valuation of the startup and the bet you're placing for that round? Is it more specific to the company and the problem it's solving? Can you talk more about what a strategic investment looks like?
Yeah, this is something that, this is not something that I learned from like a venture capital course. So I don't know exactly if the terminology is exactly correct, but, in my own mind, I divide up the ways in which I can be helpful versus just the capital that we provide. And I sort of put that into the more of a strategy category. So it's not so much about the strategy of our fund, which would be if we were like sort of trying to financially model out, what the outcomes would be, it's much more about what the impact is of the fund. And so, yes, looking at the companies, what they do, looking at how we can accelerate women leadership in this certain category of company, or looking at an educational problem that's being solved that we feel like is being ignored by most other companies or most other customers of edtech products. So, for example, like one thing that I've been very interested in over the past couple of years is, what is the learning from COVID? What are the ed tech products that have really like experimented during COVID in this like emergency kind of global, grand global experiment of doing all this online teaching and learning? Like, what are some of the lessons learned from that, and how can we really support tools and platforms in an ongoing, sustainable way that worked during COVID, and how can we get those into school systems, now after the fact? So things like that. So we'll have a few grant thesis that we're sort of, gearing those strategic investments around. But yeah, so it's more about the strategy of the companies and sort of putting them into like an impact related thesis than it is about the financial modeling of the fund itself.
That makes a lot of sense, because if a company is going to have a big impact, then naturally it makes sense to invest in that company. It's probably a pretty good investment just based on how big of an impact it will have.
Yes. I mean, certainly especially in the realm that I work in around education, and I would put healthcare in this category also, where, these are, critical, areas to invest in, both from like a government level, individual level, and then everything in between. So like, these are areas that the government is really investing in. And then we have like payees, like either through families or, in the healthcare area, individuals. And so like, what's going to fill in the gaps like in between there. And these are, mission critical to like our country and our future. So those categories are areas I think everybody will be like, the products that come out of those are for everyone. And there's huge markets for that.
Can you talk about what you're seeing on your end that we aren't seeing yet, but we probably will in the future? Just because my mom's a fifth grade teacher, so ed tech very much impacts her, and she sees the impact that online learning has had on her students. So what are you seeing?
Pros and cons, I'm sure for good and bad.
Yes.
Yeah.
Yes, where it's, if the student can't go to school, they can still learn, right? Because they can send the videos, they can do the learning, stay at home. But then there's also the problem, well, they're probably also going to be distracted a lot of times because now they all have their tablets, or it's a lot harder to kind of manage and keep them accountable. So what are some of the ed tech, I guess, startups that you see, and what are the problems that they're solving that makes you really excited for education going forward?
Well, I mean, I think probably no podcast goes by without somebody mentioning AI, like right off the top. So I will say that AI in education is a huge trend, and it is a really important one for sure. I think that it's the way in which, and this is just this low hanging fruit of like using AI for productivity enhancement at the teacher level alone, I think could really revolutionize education. And that's actually what I'm seeing the most of. Most of the tools that I'm seeing come out in the K-12 space, at least, that integrate AI are doing it for the benefit of teachers to save time. And there is no more holy grail out there than like saving teachers time, because everything they do is just like, I mean, their workday is 7 to 7. That's just what's in front of the kids. And then you have to do all your actual work afterwards. So if there's a way to actually save teachers time, I think that's what we've all been searching for in the ed tech space for decades now. And AI has the biggest potential to help with that. Now, what teachers are going to do with all that extra time, that's the really interesting question, I think, is how can then teachers spend more time getting to know their students on a more personal basis? How can they do more project-based learning and, or more other kinds of progressive pedagogical tactics to do teaching and learning? Maybe we can be better at integrating hybrid learning where they're remote sometimes and in person sometimes. And this is all, fostered and facilitated by the technology underneath. So there's a lot of excitement about AI in education, and I think it's tricky because education is usually about 10 years behind any kind of technology integration, and in some ways that's very useful. Like it gives us a long kind of crystal ball, like to look ahead and see like what are people going to be doing in the future, and take our time integrating that in. But AI has hit education like first in some ways. I mean, it's been around for a long time, so I'm not trying to say that It's the first implementation piece, but it is the consumer facing AI has hit education at the same time as the average person, and with chatbots or ChatGPT, specifically, but also chatbots and different kinds of behind the scenes machine learning integrations. And that's really hard for education. Like, we're not used to being on the vanguard of integrating a technology. So it's problematic, but it's also, I think, an exciting time to be investing in that space. I have a few investments in that space.
So, Jessica, what tends to happen to me when we have really interesting people on is I have like a few questions that are completely unrelated, and I try not to jump around all the time. So I'm going to do my best to try and connect them. We've talked about ed tech a lot, and it's the basis of most of your investments. So what makes you so passionate about ed tech? What is it that has made this niche something you really love?
I mean, I really have spent my whole career in it. So I started, my very first job out of college was I actually produced and directed a short film that then I took around to schools and used with teachers and students in the classroom. So like, I've been doing this like integration of media and technology and sort of getting the teacher workforce a little more upskilled around using new kinds of tools and technologies in the classroom for a long time, really long time. So it's a little bit of just like, I've made a huge investment in this space just with my own personal time and interest. But it's really because it's so rewarding. I mean, just actually seeing the way that a whole industry can change over time has been really exciting. And I don't think there's any greater mission than investing in kids and their education. So that's a very meaningful and very purposeful reason why I've sort of am in that space. I also think that it is a really undervalued investment, a real area of opportunity that we could all be doing a better job figuring out who are the customers for these kinds of products and how do we build things in a way that can really reach them. And in our country specifically, like part of the work that I've done over the years is look at what's happening outside the US a lot. And if you look at LATAM or India or other parts of Europe, English speaking parts of Europe, and certainly the African continent, like you see a much different personal investment in education and from families specifically. I think here in the US, like we do a lot of outsourcing of school. Like we just sort of say like, okay, that's like, we're paying for school either through taxes or there's tuition or there's some kind of like way in which we pay for it. And then, okay, you take care of it. You take care of all of that work of it.
Right.
And that doesn't happen in other countries. It's actually like very different. There are very different models. And those models are starting to kind of trickle into the US slowly, which is an exciting thing for me to see. And I think it's just making it a bigger market and opportunity, to do this education work from a lot of different angles. Either the part that's subsidized by government, the part that's in person, the part that's more driven through technology platforms, the part that's very consumer facing and or passion driven. We're seeing a ton more of kids into the homeschool market over the past 3 or 4 years, partially because of COVID, but now maybe through choice. So I just think there's like a lot more options that are coming up. And then, I'm only talking about the early childhood or the sort of, pre-K through 12th grade version of this. But then there's the whole trend towards lifelong learning and how we know as workers in the space, whatever the area it is that we work in, that we're going to have to be learning all the time. And it's not the sequential thing where you learn, and then earn, just work after that. It's all very dovetailed together and tied together. And so there's just like going to be a much longer tail around learning, I think, going forward.
So I want to recall something we talked about before we started recording, because I thought it was really interesting. We've talked about purpose a little bit during this interview, and I think the number one way in which people traditionally put their money towards purpose is through philanthropy. Say that 3 times fast.
Yeah.
You talked about advocating for females to invest in what they believe in. Can you talk about why that's important?
Yeah. I think that there has been, again, like, just like I was saying about how there used to be this more sequential way of doing things where were in school for a little bit of time and then you were working. Like, and now those two things are dovetailed together. I think that's true for philanthropy investing as well. I think there's a huge interest, appetite, um, wealth transfer that supports the idea that we big and for-profit investing out of some of the same buckets of money that are available. I do a little bit of work with like the family office space and helping next generation family members figure out what their involvement is going to be in their own family wealth and the distribution allocation of capital from that wealth. And the Gen Z generation that's coming in, like they want their work to be tied to their passions and their passions to be driving the work that they do. And so this is a very authentic overlap and kind of double helixing of this world between the philanthropic and the for-profit investing. There's also a ton of advancement on the platform side of like vehicles to do that. So there's, the biggest one I can think of off the top of my head is like the donor advised fund, which it allows you to do both philanthropic and for-profit investing out of the same bucket of money, as long as you recycle all the returns back into that same fund. And that actually really jives with a lot of people's mission and purpose for their investment strategy. It's like, it's not really delineated by the I don't know, the incorporation type of the organization that you're sponsoring or you're supporting, but rather the focus of that particular work that they're doing, and the ability to have this fund that then can regenerate capital to put into more and more of these organizations. Like that's a plus, not a minus. That the funds get recycled back in.
So,
and we're seeing that on the fund side too. So like I always recommend to entrepreneurs who are raising capital to be looking for what I call mixed capital. Like don't just, tie yourself to either VC, angels or VC, but rather look also to grants, different kinds of philanthropies that can make grants. Just like the same way as like your customer could be in a nonprofit organization. Boys and Girls Club of America is one of the best customers for ed tech products. It's a nonprofit organization.
Interesting. I didn't know that. But that does make a lot of sense. So kind of to take that purpose thing a little further, if there were to be someone that came up to you and said, how do I get into venture capital? How do I start investing in these ed tech deals? How do I start my career? And maybe look at it through the lens of how your career evolved. What would you say to that person?
Yeah. I mean, I was really lucky in the sense that I had so many great mentors in this space. One of the things I do, I run the New York EdTech Meetup, and we are an over 9,000 member professional networking organization. And while we are mostly made up of educators and entrepreneurs in the EdTech space, there's also a ton of investors who come in, and we had some sponsors. GSV Ventures was our sponsor for many years. So I had great mentors that kind of helped me with the lay of the land, just like sort of how does this work? Like who's a good lawyer to talk to? How do you actually legally create the fund? Things like that. Also had the advantage of having only a single LP, which is when you're raising from multiple sources of capital, like you're balancing that all the time. And that's true for fund managers, and it's also true for entrepreneurs. Like the more investors you have, the more cats you're wrangling, on the admin side of things. So lucked out with that as well. What I know now, and the advice that I got, some of the best advice I got from those mentors at the very beginning was to leverage my expertise in some way. So many of my early investments were a very small check plus an advisory role, advising in exchange for equity. At the very beginning. So there was a real clear commitment from me and expectation from the entrepreneur of my involvement in the company at the very beginning, and a reward for that on the other side. So that's also a way to start investing, is through advising in exchange for equity. And those are investments. Like, they're not, just because you didn't write a check with lots of zeros on the end doesn't mean that you're not investing your time, energy, and expertise. And that's a really good way to build a track record. And that, I think, is the very beginning of any investor's journey, is to sort of figure out a track record, start to build the track record of investments, because every deal is going to be different. Every collaboration that you have with an entrepreneur is going to be different. Every company you see in your portfolio is going to be a little bit different. So it's all like a case by case basis. And that's what you have to do, is start building up those cases towards your own level of comfort, confidence, and expertise in it.
So, founding Copperwire Ventures. Take us through what it was like creating it and then raising the first fund, and your learning experiences and the lessons you took away from that entire process.
Well, my personal experience is so different, I think, than many other people. Like, I had access to the entire $2.5 million kind of in one fell swoop. That's actually not that's not a big fund. And it's actually not an outrageous check size for an LP to write. So I'm not trying to like diminish it. And I'm also it's not like no one else could do that. It's a sort of typical size check if you're raising $25 or $50 million fund. That's really what you would expect, hopefully, from an LP, just to keep the sheer numbers, the sheer volume of it down, how many people you're raising from. And like I said, it was just like a very experiential process of doing it one deal by one deal as we got started. Also had the very lucky, it's always hard to talk about a global pandemic as being something lucky, but we happened to launch the fund in January 2020, and we happened to have written our first checks in March 2020. And then EdTech really took off, right after that.
I didn't think about that, right?
So it was also a very particularly unusual time to be in exactly the right place at exactly the right time in terms of having capital to invest in these companies. So the first couple of years was just bananas in terms of opportunities and getting some really early wins in there. But, also like many other people in EdTech have seen since 2021, an 80% drop in valuations and EdTech investing since then. So also caught up in that as well. So there's ups and downs. And I actually come from a family business that had a kind of feast or famine cycle. Like, it was a cyclical business in that way. And so it felt very familiar and kind of weirdly comfortable and right when that happened. Yeah.
So talking about the 2021 valuation bubble, right? Instacart just went public, and I don't know if you saw the chart that was getting posted around all of Twitter, but basically I think it was everyone that invested after the Series B or Series C round lost money. Especially they lost money compared to if they would have just invested that money in the S&P 500. So can you tell us about how you view valuations and how a founder should view valuations going forward when they first, let's say when they raise a Series A, and then how should they view it if they should view it differently when it's Series C, Series D? Are there different approaches at different levels?
From the founder point of view or from the investor point of view?
Let's do the founder point of view first, and then the investor point of view second.
Okay. So for the founders, I think the big lesson that everyone's learned is not to overvalue yourself going in, because that just ratchets up the expectation of what your valuations are going to be all the way down the line. And nobody wants to raise in a flat or down round. Like, that is very demoralizing. I mean, just at the bottom line, like, it's really hard to have the confidence and the positive outlook and the ability to go out and raise capital if you're already you're going to be underwater, like, from the minute that it comes in. So I think it's all taught us to be like a lot more realistic and less frothy or bubbly about valuations. Like that, there is a downside for the founder to be overvalued at the time of investment. And now for the investor side, like, it's similar where, I mean, obviously, we all invested money at these really high valuations and then we're underwater as well, coming down the line if there's a down round or a company can't raise based on that previous valuation and actually just goes out of business completely. Like that's a full loss for the investor. So we don't want that. Also, there's when you come in, I hear what you're saying about Instacart, and I don't have as much experience investing at the later stages, so that hasn't been a particular problem that I've seen. When you're an early stage investor, oftentimes you'll get what they call crammed down by later investors. So there's also,
what does that mean?
So there's, if you come in early and then as a founder takes on more and more capital at higher valuations down the line, those later stage investors can renegotiate the terms, the valuation, the payout schedule, what they call the liquidation rights. There's different preferential treatment that later stage investors can get that then essentially dilutes or eradicates ownership of early investors. So that's a risk. It's a huge risk when you're early stage investors. Lots of risks. I mean, the company could just go out of business. The product could never find product market fit. There's all kinds of blips and ebbs and flows along the way. The company might need more money unexpectedly halfway through its journey. But that's like another risk for an early stage investor, is that later stage investors that can then basically eradicate the value from an early stage investor. So these are all things that we factor in, but sometimes being the early stage, that's when you get the big payout too. So,
right.
Those are the things that you balance when you come into this field.
And I guess if you invested pre-seed, right, by the time you have to deal with that problem, that's probably Series B, Series C. It's a much later problem. The company's already grown a significant amount. You've already definitely got a return on investment. Can you
probably on paper? There's also you don't really get a return until there's liquidation, until there's a liquidity event. So you really have to wait for the whole thing to play out before, generally speaking, unless you get bought out by a later stage investor along the way. You could also get, bought out, not just sort of.
Right. I didn't think about that though. On paper, you might have a gain, but technically you don't, just because it's illiquid, right? You don't have access to it. So you have to wait until you can liquidate it.
That's exactly
Can you talk to us about the important metrics you look at for an edtech startup? Or a founder says, hey, we want you to invest in us, or we want your advice on what you think we should look at metrics wise for this to be an investable edtech startup?
I mean, it does really differ whether you're talking about the early childhood and K-12 space, which is where I usually invest, versus higher ed, workforce development, lifelong learning. There's different metrics that you would be looking for. In my area that I really focus on in K-12, I'm looking for a personal understanding of the problem that you're trying to solve. Doesn't mean you have to have been a teacher. It doesn't mean you have to have been a parent that had that exact problem, but there is some really unique, differentiated kind of knowledge that you have about that problem and why you want to solve it. So if it's one of the companies I invested in, Brain Trust Tutors, 2 women, one of whom was a teacher who worked with neurodiverse kids and realized it's really hard to create all the materials that tutors need to do this work with students, and combine forces with a mom who had a kid who she really was challenged to find those tutors, and affordable ones at that. So they came together to solve this problem through a virtual platform that creates the materials for tutors and also helps with that sort of two-sided marketplace piece. So that's what I go in looking for. And that's on the product side. But then on the business model side, I really want to know that you know your customers. Who are you selling this product to? And what is your connection to that pipeline of customers? Because essentially, that's going to be the thing that actually makes you money, helps you figure out how good your product is, and if it's actually solving the problem you're trying to solve. All of the people that are using your product, those are the next most important thing that I try to suss out from a new investment.
So this is always a question.
And hopefully they'll get a little hopefully there'll be a little traction along the way. That it's not just that you're selling to one customer, but that you're getting more and more, of course, along the way.
Right. Right. So this is always a question that I am interested to ask venture capitalists. There's obviously a difference between an accredited and a non-accredited investor, and there are barriers to entry to being in some venture deals, and some angel deals, and some most private deals. Should venture capital be a part of everyone's portfolio? And how do you view venture capital as it relates to who should be able to invest in it and what your qualifications should be?
I actually have been, over the last year or so, as I'm building out Fund 2, becoming more kind of disillusioned with venture capital, like what the purpose of it is, like as we were talking about from the very beginning, like what are the kinds of companies that it privileges and promotes through the way in which that money is deployed. And so, part of Fund 2 structure is actually going to be building in a lot more of this like strategic investment piece where the investors in our fund are also going to be able to provide that strategic advice to the companies that we eventually invest in, as opposed to just the GPs as well. Like I really want to bring the LPs into that part of the learning and the ecosystem that I was sort of evolving towards as we deployed Fund 1. But that said, and moving on to the next part of what you're saying, like who can be a venture investor? I think really the way to evolve the whole industry is to bring more people into it. Like I think it needs to diversify at its core, like who would be allowed to do that. I do understand the accredited investor benchmarks that have been established, the legal benchmarks around it. And I would not want to take advantage of people who don't have some investing experience to get into this incredibly risky, incredibly like Wild Westy part of the investment landscape ecosystem. I mean, you could be a retail investor investing into public securities. There's a lot of ways to get your chops up, like investing in more regulated parts of the industry than venture capital. Like I think that it really is for people who understand the risk involved. And I don't think somebody's income necessarily assesses whether they understand the risk or not, but at least it gives you a little bit of a speed bump. So it's not just like anyone can do it, just, willy nilly. Like there's a little bit of checks and balance around it. You have to think about it before you just get into it a little bit.
Right.
I do think there's really interesting ways that more retail level investors are coming into VC through crowdfunding. And so the platforms like WeFunder and Republic, you mentioned, like those are areas where I think people are getting their feet wet in it at very small check sizes. And that's going to be, like I said, it's really experiential learning. Like you got to do it. You got to build this track record. You got to build up the cases, the case studies within your own portfolio. And your portfolio can be a mix of things that are maybe they're investments that you made into a nonprofit organization, sort of like same size checks that you might write into a company, but it's more into a nonprofit. Maybe some of this is through crowd fundraisers where you're writing small checks and those are part of your portfolio. Maybe it's doing that advising work where you are a kind of angel level advisor in exchange for equity. Like all of these things can go into your personal investment portfolio that give you the experience to take bigger and bigger risks along the way.
I think that's a really well-rounded answer, and I think that's a really good point about where equity crowdfunding plays. It can be a really good learning ground for a lot of people that want to understand what venture investing is about. And I never thought about it that way, but I think that's a really interesting way to think about it. We are getting a little short on time, but I wanted to make sure I gave Madison a chance to ask a question. I know she's got a really good question, and she was really excited to listen to this interview. So, Madison, go ahead.
Yeah. So, can you hear me? Okay.
Yeah.
Okay. So, I was just kind of astounded by the huge disparity between men and women funding. And my question is, why do you think that disparity is so big? And what advice would you give to women entrepreneurs seeking funding, knowing it's so hard for them to get?
Yeah, I mean, I've grappled with exactly that over the past almost 4 years now. Like, really, like, what is a way to solve this problem? Because I don't think it's necessarily just only pitching to women investors or only or taking a male co-founder, kind of a token male co-founder on your team, which does increase your chances of raising venture capital to more like 16 or 17%. So there is that strategy as well. I don't think that either one of those things necessarily solves this problem, but I mean, it's really going to have to come from the venture industry itself and like really wanting to not just invest in women, but invest in different kinds of companies. Like that we would have the venture framework of front loading, like fronting the money to build great companies, but have that be possible for a more diverse kind of company than we typically see right now. So it's really going to take an evolution of the whole industry, not just like having more women GPs on funds. Although I think that's like, you know, bottom line, like that should already be happening, of course. But you know, like not all the companies that women start are like appropriate for that particular, like just because it's a woman partner at a VC fund, like maybe that's not the area, like maybe it's a deep tech company where there's like a different partner that has a lot more expertise and conviction around the kind of company they're starting. So, you know, I just think it's going to take a lot more time as we, and this is really happening. I've already seen it happen over the last 4 or 5 years, and I think we'll continue to see this, that the kind of company that gets funded in the venture capital style way is diversifying a lot, and I think a lot more women are just starting those companies.
Well, I think that's a great way to end the interview. Really good answer, and great question, Madison. And
thank you for asking it.
Yeah.
Of course.
Jessica, thank you for your time. I really enjoyed getting to know your frameworks and perspectives, and definitely gave me a different way to think about a lot of different things. So thank you for taking the time to talk to us. I really enjoyed it.
Well, good luck to you guys too as you build out your podcast. I know you have a real brand here that you're starting, and I look forward to hearing all the different voices that you're going to have.
Thank you, Jessica. Quick before you leave, any female founders listening, how can they reach you? How can they connect with you? What's the website link?
Yeah. So our website is copperwire.ventures. Like I mentioned, we have a form. We're not making any new investments. So it's more about if you're looking for support in your fundraising strategy, or you're looking to connect with other female founders. I do a lot of work around that as well. So feel free to drop your name into there. Also, I'm on LinkedIn. That's like kind of sadly, my social media of choice now that Twitter has completely imploded. So I'm not really on Twitter or X, sorry. But I am on LinkedIn, and that's always a good way to reach me as well. Just my name, Jessica Millstone.
Awesome. And we'll put those links down in the description so that you have easy access to them if you're watching. So yes, thank you so much, Jessica. And for all the listeners out there, we will see you next time on the Next Big Thing podcast. So long.
Bye.
Bye.
Thank you, Jessica.